Hello, everyone, and welcome to BFW 2401. And this is part 4 and the last part of the 4 parts for bank capital of week 5. This is maybe the longest part, and it contains some calculations, but it is built on the concept we started on the last 3 parts. So in the 3 parts, after we defined the capital in part 1, and we talked about the target capital in part 2, and then part 3, when we talked about the sources of capital, specifically the internal capital, we touch on some issue, an important issue called the dividends payments and the dividends payout. Now we come to this part where we say we are going to grow after all these considerations, and assuming we have set the target capital, assuming we have set the dividends payout, how much I can grow and how much I can increase my assets. That depends on how much return earning coming and how much is dividends I'm going to pay. But we want to transform this concept into calculations. And having said this story, please follow me in the following 26 slide, and hopefully I will also finish it in reasonable time. Now, this is actually the part 3 or 4, and we are talking about now the data analysis, which may used by bank managers. So we have 2 calculations, as I told you, based on the target capital and also on the dividends payments. We have something called internal capital generation rate. We usually call it ICGR, and this one is a very passive. And as I have explained it before, whatever capital is going to be increased from the return earning, increase the assets accordingly, then the same percentage, and you just continue, because by this you keep your target capital stable during all these planning periods. Now, the question is, what if I don't want that and I want to grow more? Literature provide us, and the practice provide us with other method called asset growth model. This is when the growth is actually higher than what the return earning or the internally generated capital is enough to support. So therefore, because it's not enough to support, and we have to see what we can do about it, and usually we will take, of course, external capital. It's just we want to know how much and how. So if we go to the ICGR calculates the asset growth rate, which can be supported by a given amount, of internally generated capital. As you can see from now, this model is a very, very passive. You don't actually, bank management do nothing. They just look how much capital is there, and then they increase the assets. This is the formula. So as you can see, if you look at it, this is actually the capital beginning of the year. And this is how much I get from the returning. And I minus it from the dividends. That's all, but I want to transfer this to numbers. So if I give you these numbers, and I told you my target capital is 7%, which I already have stated long time ago, and the return earning 1.2% per annum, and the dividends payout is 45%. So this policy have been set, and it's the payout. Now, the capital is also have set as a target. Now I just calculate and find it to be 9.43%. What does it mean? It means my capital grow by 9.43%, and accordingly, therefore, my asset should be growing by 9.43%. So I can keep always the 7%. Now, if I tell you there is no dividends, there was no dividends, of course, the first answer will tell me, I think I will have more capital. You bet, you are right. Because if I take the D here, As I said here, what if the bank distributes zero capital? Of course, if you calculate it, you will find it 7.14, and I want you to try it by yourself using the sum numbers. So as you can see, I jumped from 9.43 to 17.4 if I decided not to pay dividends. So I can grow in my asset up to this. And this is why I tell you, dividends is actually very important if we can convince and transform and communicate well with our shareholders and make them happy of or understanding of not paying dividends because we are going to grow. This is how much we will grow, which is almost double. Okay, so now coming back to the question, even if we are talking about this, zero dividends or with payment of dividends, is that what I want? Maybe I want 20%. Maybe these new areas, if I'm talking about, you can talk about your country, Indonesia, Sri Lanka, Malaysia, Korea, whatever. Even in this country, I want to go to an area, maybe a new area, and that maybe I am planning to take all the 50% of the housing loans in that new developed areas, and that will increase my capital, my assets by 20%. So actually, according to this, 14% is not enough for me. So if this is not enough for my planned growth, then in this case, as you can see, this model, asset growth model, we go now to the asset growth model. And the asset growth model is proactive. I mean, it has a dynamic there where you can check how much capital is there. If it is not there, then you have to do something about it. So the asset growth model allows us to test whether the return earning is enough to support our projected growth. And to do this, of course, we have to do with profitability and dividends and planned asset growth. These three factors actually will affect the formula of this model. And to look at it, it is actually the asset growth model allows us to do what to forecast the projected capital position at the end of the planning period based on the current settings of dividends and profitability. So this model assumes only there is only the internal generated capital, which is actually the return earning. So this is actually 3 steps process. And let's look at what is this 3 steps. So the first step is actually use the asset growth model to project the bank capital position. This is one. Now, when I assess when I estimate the projected bank capital, what do I mean by projected bank capital? Means the capital after 1 year, end of the year. So I am here, beginning of the year. I want to check if by planning for next year to increase my assets, I want to see how much is the capital beginning of that year, which I will increase my assets. So in this case, in the second step, I will check that. I will check the capital target. I will see whether the capital will support actually the growth. And what is the measure there? If my internally generated capital is actually supporting my growth, then in this case, which means I am still on the target capital. I'm still in the target capital. I still can increase my assets. I still, my capital increases, allow me to increase my assets with keeping the constant target capital. So, and this is actually very rare. Usually either we are a little bit more or less where we can do something about it. So, which is the third step. Usually we are even more or less. So if we are less, if the projected capital position is less than the target capital, I have to do something. I have to bring it back to the, I have to use external source to raise more capital because I already used the internally generated capital, all of it. but my growth still need more capital. And so I can comply with the target capital. So in this case, I use external capital. But sometimes maybe the news is so good and the year is so good, which my target capital, my projected capital position after the operation is even more than what I want to have, because it supports my target capital and more. So in this case, I have to reduce it. And the way to reduce that capital, I may increase my dividends payments, or I may do what we call payback. Now the payback shares, I go just and buy my shares from the market and use this extra capital. And this is a good thing to do. So following the asset growth model, we have to look at the capital beginning of the year, the asset beginning of the year, and look at the capital end of the year, asset end of the year. And we have to take into consideration the asset growth rate, which is the planned asset growth, which means how much I want to grow. And how fast my planning portfolio, my growth in the planning portfolio. All in all, it means how much asset growth I will have. So if you come here, you can see here, if I have, this is actually the ratio beginning of the year, and it should be equal to the target capital. This is the ratio end of the year, which means I will take the capital and beginning of the year and the target and the capital beginning of the year, the asset beginning of the year. This will give me the percentage of capital, target capital beginning of the year. I will add the retained earnings, and I will add the growth to the asset, and I will check how much this one. Now, I didn't assume here any dividends, but the model will assume it when we come here. See, the model now assume it. So this is the C1, this is the A1, which means if you look at those, this is the capital beginning of the year, the percentage of the capital or the capital target beginning of the year. I will add this area, all this area until the ROE, which is I am increasing my assets, growing, times the ROA, the return, minus the dividends over the asset plus its growth, and I will see. So this is CRN, you can call it CR1, which is capital ratio in year one, or we can call it projected capital ratio, PCR. So in this case, we need all those components to calculate the CR1. And I can give you some numbers. We will go with the 3 steps which we talked about. So here, in order to calculate, of course, the model, management would need to conduct a series of simulation and sensitivity analysis, which means you have to follow those numbers. How much the ROA, it should be based on simulations and forecasting. Those numbers should be accurate to calculate. So if you mess up in this one, your plan's actually not clear. Of course, the dividends, you have to be sure about it, which actually can be based on the constant payout, and also the growth. When we say I'm going to grow 10%, are you going to grow 10%, or are you talking about growing 10% and you put in the model 20%? It's different. So this, the management has to come with some forecasting and calculations and simulations to reach to a good, a very accurate number. It cannot be 100%, but we assume that it will be a very correct number. Now, this is the model. If I tell you the capital beginning of the year was 250, and the asset was 2,500. And then we expected the return on asset, which means the profit to be 1%. We expect the growth to be 10%, and we expect the dividend, and the dividend settings is which is the payout 40%, and we assume target capital of 11%. We assume just a target capital of 11% in this case. Now, I can start here, I'm assuming a target capital of 10% for next year. So I will add this one, 250. So in this case, when this is we are just calculating now according to this growth and all these issues. So we have the growth of the assets. We haven't talked now about the target capital. We just say we will achieve 9.69. Is this what I want? Of course, it's not what I want because my target capital is 11%, which means basically without even going to the next slide, you know that I have shortage and the internally generated capital is enough and I have to go for external sources. So if I come now and they tell you this is 9%, you know that I will have surplus. So in this case, as you can see, first step, we calculated 969. And second step, I discovered that the 969 is less than the 11%. Now I have to decide how much I should raise. And we will use this formula. So we will take the projected, to calculate the capital access or the shortage of it. And this is very important, is to actually go through the projected ratio minus the target ratio times the asset beginning of the year times 1 plus asset growth rate. So if I calculate this one, as you know, if it is a positive value, as we said before, we have to get rid of the extra capital by payback or dividends. If it has a negative value, then I have to get it from somewhere else. Now let's calculate and see. And as we calculate, we can see that we are missing 36.25. Now it's time now to raise it. So we have a negative value and we need to raise more capital from outside external capital because we already, according to the model, already executed the internally generated capital. It's in the formula already. So in this case, we can also play with these numbers if we want to see, maybe we change our planned asset growth. We say, okay, we have problems with acquiring more capital from outside. Maybe we don't have to grow 10%, maybe we grow less. So in this case, we will decrease this amount. We can calculate this amount. We can assume how much, if we just, we can decrease it based on how much we can raise as external capital. Also, we can change the dividends payout. Of course, I can play with this formula by playing with this number. If I play with this number, of course, the target, this one can be higher. If I play with this number, the 40%, this can be higher. Maybe I don't need. So it's the dividends or the growth. Now, having said that, maybe this is the most technical one, which is an easy thing for you, I think, to understand. Let's see what is the external source of capital and where they are. And I know, I think I can issue, we are talking about capital. Huh? So if we are talking about capital, so we are talking about ordinary shares or preference shares or what we call EPRA approved. Now you can even forget if you are not aware of what I mean by EPRA approved, you can talk about central bank or regulator, central bank approved hybrid securities. Now, what this hybrid security means? Hybrid security means you can talk, as I told you, about your central bank. This is the Australian regulator. So we can talk about the hybrid security. But what is this hybrid securities? That security which I take it as a debt, but if I'm not willing to pay or cannot pay, I will not pay it. And in this case, I can change it to equity. So this is the best quality. Let's talk now about each one of them, explain them. I think you know the first one, which is ordinary shares. As you can see, this is the best quality capital in the sense that this type of capital, remember what we mean by quality capital, the access to that capital, and whether it's free to use it to cover losses, because all our concern now is to have a capital that we can use if we have unexpected losses. So this is the best source. which is the best quality capital in the sense that this type of capital provides the largest reduction in capital risk per dollar. We have the ordinary share can be raised through right issues, which we can tell our current shareholders that you have, I'm issuing, for example, 100,000 shares new, and I will make a proportion of the new ones and sell it only to my shareholders. So if I am, if I have 1 million in the market and they issued 100,000 more, so every share in the market, which is already bought, will get what you call 10% of a share from the new issue. So if I have 1 million shares and I issued 1 million shares more, so every shareholders who have 1 share will receive 1 share. If it is less than that, then I have to do this proportion. This is what we call the right issue, which only goes to the current shareholders. The new issue is an offer to public target, like what we do in the IPOs. We just sell, we can look for, underwriter, like one of those investment banks, he take all it and sell it for the public, whoever they are. And we are the third one, of course, we have private placement where we can only talk to a group of investors and we agree with them, or a group of investment banks and sell it to them. Now, shareholders receives, of course, we know what shareholders will receive. They are receiving, according to this ordinary share, is just the residual, which means after we pay for depositors, preference shares, and all of those liability holders, whatever left goes to the shareholders. We understand this. Now, the second type is this preference shares, and it is a hybrid securities. What do you mean by hybrid securities? It's between debt and equity. Yes, they don't have voting rights. And actually, when we liquidate, they will receive, we will pay for everybody and for all the debitors, and then the preference shares, and then the common shares. So they come a little bit one step above the equity, the common shares. And they receive those people, when we say hybrid securities, this is from the perspective of being, when we say hybrid, which means part of it is equity, part of it is debt. When we say the equity part is, of course, they don't have voting rights, but in terms of the residual payment or residual claims, they have some preferences over the common shares, which means this is where the word comes from, the preference shares. Now, they can be, I think we have talked about it, cumulative and non-cumulative. And we are, in this case, we are talking about non-cumulative and redeemable. And this is what make it, more like equity. And if we say cumulative, it becomes more like a debt. So this is how we define preference shares. Now, this, what we call approved hybrid securities, must meet major characteristics. So interest payments will be there unless the bank decides to withhold it if it is in difficulty. Essentially, this is a debt issued by special purpose vehicles. They are interest paid and they have no voting rights. I think what you're concerned in this case when we talk about capital is the payment, because what differentiates a debt from a capital is the servicing expenses, which means the interest. If we are servicing that, capital, it becomes actually a debt because it has to be paid. But here we will pay it, but if we are in difficulty, then we don't pay it. Now we go to the one more issues, which means factors to consider what capital to choose. We can consider the capital risk, which means we know that the higher the quality of the capital, which means when we go to common stocks, then when we go to preference shares and we go to hybrid securities, the most that can absorb much of this capital risk is actually the common stocks. But the problem, it's expensive. So you have also to take care of the cost. This is another consideration to look at it. And actually, you have also to look at the timing. What do you mean by the timing? If the share price is very high, my share price, as I told you before, it's time now to issue more shares, and maybe we go with the common shares option. It's the best because my share price is very high and I want to take advantage of that. If it is low, it's a different issue. And then we have also to consider the issue of dilution. And I think accounting people know what I'm talking when we talk about dilution. And I think most of you already knew. So dilution effects is when I issue more common stocks, actually I'm decreasing the earning per share, because the earning per share is the net income over the outstanding shares. So if I have outstanding shares of, if I make, for example, 10 billion, bring it to profits, and then I have 10 billion shares in the market, 10 million shares in the market, then actually every share would be, earning per share would be, if it is 100 million, for example, profit, and we have 10 million shares, then every share would receive something like 10%, 10 cents. Now, if I start now to issue another 100 and becomes now 200 million shares, and I still receiving only the 10 million profit, then in this case, actually, the profit will be 5 cents. So this is what we mean by dilution effect. And somebody would say, and why we should do that? Why we, the current shareholders are, allowing this thing to happen? Actually, when I increase the capital, another 100 million, the assumption is that the earning per share and the net profit will increase and double, or maybe, triple. So there will be increase, of course, in the profit, and hopefully there will be no dilution in the earning per share, okay, or in the dividends payments. So this is what we are talking when we talk about dilution. So issuing preference shares or hybrid has lower dilution effects. As you see, it's only, this apply only for the common stocks, and for the, preference shares and the hybrid securities, it's actually less. So what is the definition of dilute? Is, decrease or weaken or reduce the strength. I'm done for this part. Thank you very much. And I'm actually done with the 4 parts. Hopefully, I like this way of decreasing it, dividing the concept. And hopefully I will take a feedback from you, whether you like it this way or maybe I change, because I'm changing all my slides now to this style. I will take some feedback maybe in the next workshop to see whether you like it or I should change this approach. Thank you very much and have a wonderful weekend, and see you. Bye-bye.